Welcome. My name is David Bickerstaff. I am a consulting actuary in the Dallas-Fort Worth area. What I'm going to do in this video is to give you a demo of a model that we have constructed that will address what I believe to be one of the critical issues for an entity contemplating the setting up of a captive insurance company. And a captive company that would be seeking to set this captive up in one of the 20-odd states with captive divisions that would serve as a domicile for the captive. The issue we're talking about here is the adequacy or the effectiveness of the proposed reinsurance plan for the new captive. Now, what we're dealing with in this particular example, of this model, is a line of business, probably a liability line of business that's characterized with a high severity, low frequency, high uncertainty and variability, which would call for an excess of loss reinsurance contract. Now, I've got two versions of this model, and this first one, which by the way will be in two parts because of the length of the demonstration here. This first version deals with a swing plan for the reinsurance arrangement, and so if you've gone this far with me, I'm assuming that you are part of the business. That is, you're part of the insurance fraternity, either an entity itself that's seeking to form a captive, or regulator, or a captive manager, or reinsurance company, reinsurance intermediary, somebody in that general field. So I'm assuming that you're familiar with the terms that we're going to be dealing with. In fact, in setting this model up, I got some great advice from one of the more respected captive managers in the country, one of the most respected reinsurance intermediaries in the country, as well as a very respected Lloyd's broker in London. You might say that this model is a culmination of several years, decades actually, that I had with the issues of setting up a captive, either with setting up rate levels, doing the actuarial studies, doing pro formas on a expected basis and a so-called adverse case basis, the whole 9 yards as far as the actuarial input for setting up a captive. So over that period of time, we have accumulated quite a bit of experience in this field, and this model basically is a result of those years of experience. So now, what I want to do with this example, which is a swing plan, I want to walk through about 5 screens that will demonstrate how this model works. Now, the first part of this model is to define the entity itself that is attempting to set up a captive company. And that's what this first part of this screen does. And the first item is pretty obvious. We want to determine how big is the entity, what total premium volume are we going to be dealing with. So for this example, I have chosen a nice round $5 million. Now, that would probably rank as, relatively small captive, but we'll start with that. I say $5 million, but you have to also define at what policy limit we're dealing with as far as that $5 million is concerned. We're going to select, in this example, the $1 million limit. So we expect the entity to produce $5 million of premium at the limit of $1 million. Next item would be, given that premium level, what is the expected expense provision in the rate? Now, let me say, before we get into that, we're going to be throwing in quite a few of these parameters that define the entity. For each of these, we have a default value thrown in here, each of which can be overridden to define the specific entity in question. So these values at this point were those that were probably included in the original actuarial study in the process of getting the documents for the captive. So the expense loading underlying the rate, in this case I'm using 35%, and that includes the usual provisions for general expense, commission, brokerage, in this case unallocated loss adjustment expense, and a provision for profit and contingencies. So with 35% expense loading, this would imply, of course, that the expected loss ratio built into this original premium level is 65%. Now, in many cases for a liability line that we're dealing with like this, the original rate level will include a loss provision which has been discounted to present value based on a given interest rate and a presumed payout pattern of claims over the next 5, 6, 7, 8 years. So what we've got here, we're assuming that this loss ratio, that the losses underlying the loss ratio of 65% has been discounted at 2.5%, which produced a present value of 0.9288. So to determine what the undiscounted losses would be, we're going to take the 65% and divide by the 0.9288. Now, this is not always included in an original rate level. There may not be any discounting. In this case, we would just enter 1.0 and be done with it. A couple other things that are very important to determine and record here in defining the entity. And this one is very important. The average indemnity expected at the underlying limit, in this case it's $1 million limit. So here we're assuming that it's $200,000. Now, the actuarial report may not have this. Most of them would, but it is we're going to be talking about an excess limit here, so we need to know what the average indemnity is at this underlying limit of $1 million. So I'm using $200,000 here. Now, given a total claim frequency, we want to input what percentage of claims we expect to close with indemnity, and that here I put 25%. Then of the remaining claims, what percentage of those total claims would we expect to close with expense only, CWE, I put 0.7, and that would leave 0.05 to be closed with no payment at all. And then a couple of other expected averages. Average loss expense on claims with indemnity, I put 30,000. On claims closed with expense only, I put 20,000. Now, some reports producing a beginning rate level may only have one average for all loss expense. In that case, put the same one in both of those boxes. Now, this last item here is important because many swing plans, in fact, many excess of loss plans in general, will state that the retention may be different for a single defendant incident compared to a multiple defendant incident. For example, the terms may say that for two defendants or two or more defendants, the retention for the ceding company, the new captive, will be twice what it would be for a single defendant. So in order to account for that, we have to put in here the ratio expected of defendants to incidents, and from that, we calculate what's the probability of claims with one defendant, two defendants, and three defendants, and so forth. Now, all of these, I use the word expected quite a bit here. Each of these represents, I say expected, but in this context, the word expected represents the midpoint or the mean of a fairly wide distribution of possibilities. And when we actually work the model itself in a minute, we basically are sampling so many claims. Each one has an expected value of these parameters right here, but the actual value for a given sample may be on either side of this mean. Okay, so that is generally what we're looking for to define the entity itself. Also, I might mention that in entering values in these first cells here, there is built into the model a filtering mechanism that produces a range of reasonable possibilities. So if you put something like 0.9 here for the CWI percentage and then 0.8 here for CWE, which adds up to 1.7, that's impossible. It'll tell you, wait a minute, you can't go past 1.0. Anyway, those sorts of filters are built into the input area here. Now, okay, we've defined the entity. Now let's look at the actual terms of the reinsurance plan being proposed for this entity. In this case, again, this is a swing plan. Generally, swing plans work on a 3-year cumulative basis, and we'll deal with how that works in a minute. So we start here, obviously, the first important parameter is at what point does the reinsurance excess of loss attach? And let's choose 250. So 250,000, meaning that the excess of loss layer will be 750x of 250, which is fairly typical. Now this next item is an item that more than likely will be found in the original actuarial report dealing with the rate level of the initial rate level of the captive. And this would, what I'm calling the decreased limit factor. Most rate studies will, well, maybe all of them will include an increased limit factor table. And typically they start with the base limit of 100,000, 100,300 as a factor of 1.0. And all of the higher limits will be some factor above 1.0 all the way up to the million, in some cases, up to 2 million, 5 million. So what we want to do here is to translate that increased limit factor as a decreased limit factor representing the ratio of the factor for this retained limit of 250 to the limit underlying the premium level, which is the $1 million limit. So for example, if the increased limit factor for 100, 300 was 1.0, for the 250 limit was 1.5, and for the $1 million limit, let's say that was 2.0, then this decreased limit factor would be 1.5 divided by 2, or 0.75. Now, let me emphasize here very strongly that at this point in the consideration for this entity to form a captive, we're assuming that the actuarial report and other documents submitted to the regulator have been reviewed, have been passed on, and are deemed to be a reasonable estimate of the expected value of all these parameters here. So we're not in this model second guessing any of these parameters that you're looking at here. That's another thing that we have personally been involved in for setting up initial rate levels, pro formas, you name it. But that's not what we're doing in this model. We're testing the ability of this reinsurance arrangement to respond to the losses in the excess layer and how fair that set of terms is to mitigate against those unexpected excess losses. Okay, let's continue on here. I mentioned up here that some sets of terms for excess of loss treaties set up a separate retention for multiple defendant cases. What I'm doing to account for that in this model is to input a ratio. I'm calling it the ratio of the retention per occurrence to the retention per defendant. I'm going to use 1 here, which simply means that no matter how many defendants are in a case, the ceding carrier will retain $250,000 for the entire occurrence, no matter how many defendants. If I had put a 2 in there, it would say that for multiple defendant cases, we got a retention of $500,000 and so forth. But here I'm going to use a 1.0. This next item is fairly self-explanatory. The ceding carrier would almost universally be required to submit a deposit premium to the reinsurer, and I'm saying here it'd be 20%. This is a percentage of this $5 million annual premium. In this case, it'd be $1 million. Some of these plans have an aggregate deductible, sometimes called an inner aggregate. Again, those of you listening here are still with me, you're familiar with these terms. But anyway, the aggregate deductible says that essentially, and let's put a number in there, let's say 15%, 0.15, means that 15% of the gross premium, which would be what, $750,000. So the first $750,000 of excess losses in this layer of 750x of 250 would still be retained by the ceding carrier. And then after that amount is reached, then the reinsurer responds with the ceded losses excess of 750x of 250. But for this example, I am going to assume there is no aggregate deductible. I'm going to put a 0 in there. And then the terms of the treaty almost always includes an absolute cap on recoverable losses as a ratio of ceded premiums, and I'm going to use 2.5, which is fairly typical ratio. Then the real nuts and bolts of the plan on a swing basis are these last 3 numbers. The swing premium is determined very simply, as you know, is the minimum premium, and these are ratios of that $5 million premium of your the minimum premium plus the product of this loss conversion factor, and I've used 107.5, times the actual ceded losses in that layer. And it's all subject to a maximum premium of 35% of the premium. But again, this is going to end up on a 3-year basis. So 3 years, a premium would be $15 million. So the maximum premium, ceded premium in this plan would be 35% of $15 million. Okay, now, that's part one. Okay, now, in part two, we're gonna do a few preliminary calculations. I'm gonna press that button, and using these input factors over here, it backs into a expected total claim count, that is total, some with indemnity, some with expense only, some with no payment, of about 49 claims per year for this entity. That's an annual number. Now, another way of doing this model could be, and probably would be in some circumstances, using this value of total claim count as a given on this side. If that's a number that's fairly well known in the actuarial report, go ahead and start with that, and then this average indemnity at the underlying limit would become a calculated value over on this side. For this particular version, we're calculating the expected claim count over here, and it's backed into, I won't go into the math, but it's backed into using all these parameters, about 49 claims. And then, this is extremely important, the model calculates what the what the unlimited mean indemnity would be. In other words, if you took out all limits, including the $1 million limit, theoretically, what would the average indemnity be from 0 to, well, unlimited, infinity, whatever? It would produce a number of about 230,000. So, a distribution, the mean of which is 230, limited to $1 million, would produce this 200,000. So it works its way back up to this unlimited value. And this is important because when we go through this model and sample claims, we have to have a distribution that has a mean of 230,000 and with a given standard deviation. Now the CV, which is the coefficient of variation, which is the standard deviation divided by this mean, this thing calculates it should be 1.9. In order for all of these values to be in sync, that's the standard deviation, or the CV, that would be required to do that. These are just shown, these other numbers are shown for general information. For example, the average indemnity at the retained limit, which is 250,000, would be 128,500. So now we're set. Now we're ready to turn the crank and run the actual simulation. And what that does, what this model now does, is to play this 3-year loss experience of this entity over 10,000 random trials, each trial consisting of 3 years, and each year consisting of a frequency, the mean of which is about 49 claims. I emphasize that's the mean. So it's sampling a distribution of frequency, and that's the mean. It's sampling a distribution of disposition. 25% of the time you're going to have a close with indemnity, and that's the expected value, the mean. 70% of the time it claims with expense only. Then you're going to sample, if it is indemnity, you're going to sample from a distribution, the mean of which is 230,000. and so forth. And you do that 10,000 times. What you're looking for at the end of all of this is the distribution, the probability distribution of ceded losses for this entity, and then how well this reinsurance arrangement transfers risk from the ceding carrier to the reinsurer. So I'm going to hit this button right here, and then we're going to run this company's results 10,000 times for a 3-year period. So there we go. And then we're done with that. Now, then it's going to do some sorting. Let me explain that in a second. We have basically, with this size of an entity over 3 years, this amounts to sampling about 1.5 million claims. And you see that it did that, 3 seconds? And I got to admit to you that this laptop I'm running this on is 5 years old. Clearly, there are processors out there that are faster than the one I'm using right now, and Mike could do this simulation in 1.5 seconds. So I would have saved 1.5 seconds had I gone and bought a new laptop, and you can understand what I'm getting at here. If it ain't broke, I ain't going to try to fix it. Now, when it does this sampling, it records the results in 10,000 buckets. It doesn't just throw them away when it goes through this. So when it does this, they're all over the place. So what we want to do when we have produced those 10,000 buckets is to sort them in ascending order so we can have a probability distribution. Now, all the way through this process, as we sample all these claims, obviously the first thing we're going to ask is this claim going to be retained or is it going to be ceded? Well, there are two ways that you can define a loss in one of these swing plan arrangements. One would be that you've got an indemnity, and you determine the ceded amount of an indemnity strictly by the amount of the indemnity, and the loss expense associated with that claim is ceded pro rata. The other, and you know how that works. The other way is that you've got a definition of a loss which has the sum of the indemnity plus the loss adjustment expense, and that determines what the size of the loss is, and therefore how much of it, if any, is ceded. So all the way through this process, we have actually populated 2 sets of 10,000 buckets, one treating ceded losses on a pro rata basis for ALAE, and another one treating the ceded losses on an ALAE combined basis. And for each level of ceded loss, we would have ceded premiums if that loss exceeded the attachment point. So, now, at this point, we're going to shift to screen number 2 and see where all this takes us. So I'm going to push this button. Now we've sorted out 10,000 trials 2 ways. Now I want to see what this looks like. So let's try the set of buckets that are now sorted with the ALA defined on a pro rata basis. So let's populate this graph, and that's what we end up with. This is a cumulative probability graph with 2 superimposed lines. The red line is the graph of ceded losses, namely 750x of 250 with ALAE pro rata in this instance. And then for each of these levels of ceded losses, there is an associated swing premium with the blue line. Now you can see where at this point we have reached the maximum premium, swing premium. That was at 35% of the $15 million, the $3 million. What's that, $5 million and a quarter? So that's where we are at the maximum level. Now, here's the critical part of this graph. Where the red line exceeds the blue line, it means that this is where the reinsurer is picking up losses in this area, and your premium has maxed out. Over here, you're paying the premium, and this is the difference in the actual losses and what you're paying in swing premium. The mean value of losses is going to be somewhere in here. The median, remember, you know what the median is versus the mean. The median is just below 3 million. The mean is about 3 million, give or take. And the swing premiums work over here at the blue line. Let's note that the intersection of these two lines is at about 91%. This is with ALAE pro rata. Let's see what it would be if we changed and go to the buckets that have ALAE with on a combined basis with indemnity. I'm going to repopulate this guy. Then we see that the intersection is like, 86th percentile. And as expected, you've got more ceded losses when ALAE is combined with indemnity, just by common sense. Okay, I'm going to call this at the end of part one because of the length of it. In part two, we're going to explore how one of the common metrics used to determine risk transfer, which is called expected reinsurer deficit. We're going to take these same terms and we're going to calculate what that ERD is, and that's going to be in part two. Meanwhile, even though we just finished part one, if you have any questions just about this part, any comments or suggestions, here's my contact information. I would welcome any questions at all, comments from anyone who would like to throw in their 2 cents worth. And otherwise, we're going to stop here and then start part two, and then we're going to cover some more stuff about this particular swing plan. So thanks for your attention, and check in with me in part two.